This chart tracks the price of WTI crude oil. On April 8th, it recorded a violent 15% collapse, falling from over $110 to settle at exactly $95.45 a barrel. Market shifts of this magnitude are typically tied to sudden changes in supply availability. In this case, the volatility tracked a direct change in U.S. military posturing, specifically the postponement of a planned strike on Iranian infrastructure. This rapid stabilization followed a Pakistani-brokered ceasefire, a deal that relied entirely on the status of a single maritime waterway. That waterway is the Strait of Hormuz. It is a physical bottleneck, spanning just 21 miles at its narrowest point. To see why these 21 miles dictate the global economy, look at the transit data. Roughly 20% of the world's total oil supply is funneled through this specific geographic coordinate every single day. When the war brought this strait to a near closure, the impact reached fuel pumps within days. Here in the U.S., national gasoline prices breached $4 a gallon, hitting peak levels not seen since 2022. The shock traveled further than the gas station. Major airlines, facing a sudden spike in jet fuel costs, responded by raising passenger baggage fees to protect their margins. This illustrates how a physical disruption in a distant, isolated channel can directly drive domestic inflation and consumer costs thousands of miles away. But before the prices fell, they surged. Crude hit $115 a barrel, following strikes on Iran's Karg Island, the massive export hub visible in this satellite photography. Following those strikes, the U.S. issued a formal ultimatum, threatening to target Iranian civilian infrastructure across the country. The administration imposed a strict deadline of 8 p.m. on Tuesday for Iran to meet specific conditions or face those retaliatory strikes. For 24 hours, the global energy market operated under a literal countdown, pricing in the risk of wide-scale destruction to the region's energy grid. The trajectory changed just 90 minutes before that 8 p.m. strike deadline was set to expire. Pakistan's Prime Minister, Shehbaz Sharif, presented a 10-point mediation proposal that both sides accepted as a workable basis for negotiations. The core requirement of the ceasefire was logistical. Iran agreed to a temporary reopening of the Strait of Hormuz to commercial shipping. Under the new arrangement, transit through the channel is coordinated by Iran's armed forces, a condition that Israel reportedly accepted to facilitate the pause in hostilities. Lifting that physical blockade acted as an immediate economic pressure valve, allowing energy markets to retreat from their crisis peaks. Wall Street responded with an immediate rally. As the ceasefire was announced, the Dow Jones surged more than 1,000 points in a single morning. However, the disruption left deep scars in the global supply chain. In Asia, petrochemical manufacturers were forced to slash their production because they simply couldn't secure the necessary oil-based feedstocks. This chart compares that decline against the performance of U.S. chemical firms. While Asian output fell, U.S. giants saw profits rise as they used their access to cheap domestic ethane to take over market share during the shortage. This reveals why geopolitical volatility isn't a universal loss. For specific domestic sectors, these shocks create an asymmetrical advantage by crippling their global competitors. For now, the 2-week ceasefire has provided temporary relief, characterized by plunging oil prices and soaring stock indices. But the core vulnerability remains. The world's primary energy supply is still tethered to those same 21 miles of water. This infrastructure crisis has been delayed, not solved. The global economic grid remains exposed, waiting for the next trigger to reactivate the Hormuz lever.